it's a bit a question about the dynamics on the oil curve. When I look at options further out on the oil curve, they're much cheaper because they're much more out of the money due to the backwardation. And but it also gives you much more time. So it looks quite interesting to me. And thank you, Kuppy, for the flagging. And I'm trying to see what am I missing. Why is it so cheap? What are the dynamics of this backwardation going forwards? What are the risks? How to look at this, or is it just cheap? I just wanted to see how you view the dynamics of the oil curve and the dynamics of the oil curve when time goes by and things come into spot, basically.
A really good question, and it really gets to the core of this this animal we try and wrestle, which is what is a forward price. I would one up before I get to answering your question and say that whether you're looking at the forward options, which are one way to play that, for like bull call spread 6 months out as an example, or any option 6 months out or 9 months out, but you see the same thing if you look at name your oil producer and or refiner. Every analyst on Wall Street uses the forward curve to make their forward pricing prediction. And as a betting man, if I'm looking at current price at 110 and the forward price down, you have to assume either the current price is going to fall to the forward price, the forward price is going to rise to the current price. Well, statistically, I would say that if an analyst is using the full 1 year or 2 year forward curve, that's BS. They should be using something more, maybe 3 months out for the forward curve, assuming a little bit of price decay, but a lot of price rising. What would be, if you drew a normal curve around, how does it normally play out? I'd be willing to bet the normal curve typically rises, but most analysts stick to the risk-free, I'm just going to use the forward curve methodology. And therefore you have these oil equities that slowly roll higher in valuation. And then every quarter they're like, oh my God, we had a positive surprise to earnings because things turned out better than we expected. And it's almost comical to me. Of course, it's not comical, but the degree to which they just simply blindly use that forward curve. I think, now given there's only a limited number of ways one can deploy your, assets in a war of trading to make money. I would be, I like forward bull call spreads as a way to capture that, because I think it's the lowest risk, highest probability of success way to approach that discounted forward price. And I think you always have to, the funny thing is what futures markets do, it's assume like this is the future price of oil. It's not just today. This is the future price 1 month forward. Well, why should the forward price, and the market can only price in so much, of course. And I get that. But I think, if you ask me, yes, the forward price should rise. You have to assume on any given day, today's price is where it's going to rise to. And that's what I'm assuming. And I'll be, blunt. I dumped over the last couple of weeks all non-performing, equities I had that were just boring, that might have been kind of conservative plays. I dumped a lot of them just to buy either kind of out of the money calls or double down on oil, because I see the flat price going higher and I see the equities underperforming. So I'm bullish. But a lot of it has to do with that forward curve that you're talking about. So I think the market, it's just a reality of life that the market's, the forward curve, the way it's structured, doesn't fully price in the propensity for the forward market to rise. And so if you think it doesn't make sense, you're right. That would be my take on it.
Paul, I would just add that if you go out in time, I guess the risk to those calls, I mean, obviously you're buying a lot of theta very cheaply because you're far out of the money. But the risk to those calls is the fact that if oil spikes right now, I own the 2025s, for instance. If oil spikes now, you still have 4 years to go on those. A lot can happen in 4 years, whether it's on the demand side or more likely on the supply side. And, they could bring on some supply and maybe, oil moves back to, where the curve is today. I don't think so, but I mean, I think that's what people are saying when they look at the DEES 25 curve at 72. They're saying supply is going to come on and the marginal cost of production, is there, or, some slight profit there. But I mean, that's what the curve is trying to tell you. And, when Russia, when the Russia stuff first happened, the front of the curve really spiked up. And what's interesting is the back of the curve actually gave back a few dollars because people started panicking, or people started pricing in more supply in the future because you have a spike now. I'm not saying that's right. I'm just saying that's what people are seeing. Anything you want to add on that, Bill? Or
yes, I would only add one thing, that what often gets lost in the shuffle when you see a move like that is what was probably really happening when you saw the back end go down is there was some giant structure shifting. People were covering it. If let's say you had some long dated derivatives and you had some, short front to backs against it, that you saw option traders and or long dated derivatives traders just covering those front to backs. And so that forces that back down. A lot of times, there are times when the front will jump or the back will go down, and it has nothing to do with flat price. It's just some of these long dated derivatives books just trying to get, more neutral.